Hi there. In this video, we will continue the discussion we started in the previous video when we start talking about the purchase of the assets by the parent company from the subsidiary company. We said if the parent company acquire between 0 and 20% of the subsidiary, we call it insignificant control because the parent company here doesn't have a big chunk of shares. And because the company has insignificant control, the parent company uses the fair value method in recording the investment, the dividends, and the fluctuation in the market price. So when the parent company is acquiring the shares, they put it in the investment account. When the parent company is receiving the dividends, they put it in the dividends income. When the parent company faces some ups and downs in the share price, we put it in the unrealized gain or unrealized loss. However, if the parent company is acquiring between 20 and 50%, we call it equity method, where the parent company use the investment account in subsidiary stock for everything. So when the parent company is acquiring the shares, we put it in the investment account. When the parent company is taking a portion from the net income of the company, we put it in the investment account. When the parent company is receiving dividends, we reduce it from the investment account. So the investment account is very crucial under the equity method. And under this method, the company doesn't recognize any fluctuation in the price, either ups or downs. And the final thing is to do consolidation. If the parent company is acquiring more than 50%, it can use the fair value or the equity method, but the parent company must use consolidated financial statements. And this is what I'm going to address in this video. So with this in mind, just here to make a quick recap for what we said last time, that we have insignificant control or influence recorded at fair value, significant recorded at equity method, and then controlling where we have to do some consolidation. To make your life easy, I am going to present two examples in this video that will show you how to do the consolidation. And those, you will see them available on Brightspace in a Word file like this. So this can tell you here that we have the parent company, TMI, and the subsidiary company, Setco. The parent company acquires 100%. So in this whole chapter, you will see the company is getting all the ownership of the subsidiary, but starting from chapter 3 onwards, this 100% will be changed. It could be 80, it could be 75. So for the time being, we assume that the parent company is acquiring all the ownership of the subsidiary. And the fair value and the book value are equal. So here, book value, it's equal to the fair value of the subsidiary. What does it mean? If the parent company doesn't have any difference between the book value and the fair value of the subsidiary, it means the parent company will not recognize any goodwill or bargain purchase. And now we see here that during the acquisition or in the year of acquisition, there was an accumulated depreciation here by the parent subsidiary company for $29,000. And you see here in the balance sheet, we have a very simple balance sheet that has assets. And in the assets, we see building and equipment at the net price. What does it mean? It means this is the amount after accumulated depreciation. So remember, when I record the accumulated depreciation in the journal entry, I will put it here. Now, what we need to do is to do the consolidation entry. And please, when you read the exercises on this chapter, you need to know which entries is required in this exercise. Not every exercise asking for the same journal entries. Here we ask for the consolidation entries. When I go down to the second exercise, we ask for equity method journal entries. So please remember, when you read the question, make sure that you understand which journal entries you need to do. So here, which journal entries I need to do? Very simple. Number one, I need to do the accumulated depreciation. And remember, this is not the normal journal entry. You did it in previous classes of accounting. This is the consolidation entry. What does it mean? We close the accumulated depreciation in the fixed asset account. In the previous classes of accounting, we used to say debit depreciation expense, credit accumulated depreciation. But in the consolidation entry, we say debit accumulated depreciation, credit the asset, building and equipment. The second thing, we need to close off this account, investment, 250, with the common stock and the retained earnings of the subsidiary. So let us go here and see the journal entries. So this will answer the first part of the question. How we make consolidation entries. As you can see, we reverse the accounts to close them off. Common stock and retained earnings are equity, and therefore they are credit. They have credit balance. To close them off, I put them debit. Investment account is an asset. It's a debit account. To close it off, I put it credit. The same thing for the accumulated depreciation. Those are the only journal entries we need to make. And now let us go to the accounts here. So now I need to take the same accounts to do the worksheet, and this will be the second requirements. So if I'm in your place, I will get the Word file from Brightspace, which is already available there, and then take a minute to complete the worksheet at your own, and then resume my video to see the model answer. So how to make the consolidation? For the assets, we add them together, okay? And then we put their totals here. For the consolidation entry, we enter the numbers here in the debit and the credit. So let me share with you here the model answer. So first, for the consolidation entry, we have investment credit, common stock and retained earnings debit. So now I did the first journal. Then debit 29,000 for the accumulated, credit 29,000 in the same line. Why did I put the 29,000 at the same line? Because there is no line here for accumulated depreciation. So I put them debit and credit. And by default, when you add the total number of the consolidation entry, the debit side must be equal to the credit. If the debit side is not equal to the credit, then your balance sheet will not balance. Now we need to add up the numbers. So first we add the cash, we get 91. Then we add accounts receivable, 132. Then we add inventory, 183. The 29 will offset each other, so we add 219 plus 168. Then 250 debit and 250 credit, so the total is 0. And then we add the assets here. We get 793. Then we add the liabilities, accounts payable, notes payable. The common stock credit 50 and debit 50, they offset each other, and we take only the 99. The retained earnings are the same, 395, and then the total is 793. So this simple worksheet will tell you how to make the consolidation entry and how to make the consolidated balance sheet. Now let us jump to the second exercise. So in the second exercise, the parent company, again, is acquiring all the assets. It means 100%. And they use equity method, okay? And the book value is equal to the fair value. So here you go. This means there is no goodwill, no bargain purchase, and we use the equity method. And here you can see this is not a balance sheet as the previous example. This is a trial balance. So what you see in the second example, more accounts. Why? Because I'm showing you the trial balance. The trial balance has assets, receivables, inventory, and then you go to cost of goods sold, depreciation expense, dividends declared. All these accounts have debit balance. And therefore, I put here total debit. So why I put debit? Because I put assets, expenses, dividends, all of them have debit balance. Then you go to the credit side, we'll see all the accounts and then total credit. The total debit is equal to the total credit, and the same thing for the subside. Now, what do we need to do? we need to do the equity method. What do we mean by equity method? The recognition of the net income, which is 60,000, because in the equity method, we recognize the net income, we recognize the dividends, but we don't recognize the fluctuation in the market price. The dividends declared here, as you can see by the parent, is 38. So I need to make two journal entry on, one for the dividends and one for the net income. And here you see the journal entries: debit investment in subsidiary stock, credit income from subsidiary by 60,000. And then we debit cash credit investment by 38,000. I didn't ask for the consolidation entries here, but we will record them straight in the worksheet. So in the worksheet here, it's more comprehensive than the previous example, because this worksheet will include the consolidation of the income statement, the consolidation of the retained earnings, the consolidation of the balance sheet. And if you make a mistake in the income statement or the retained earnings, then the balance sheet will not balance at the end of the day. So you need to start correctly up to the end to make sure that the debit side of the balance sheet will be equal. Now, in the income statement, we have sales, cost of goods sold, depreciation, selling, income from investments. So this can tell you here, I need to close off this account. So I put it debit because I already recognize it in my journal, and now I need to close it up. And then we add. So we add the sales, we add the cost of goods sold, we add the depreciation, we add the selling and admin, and then the income from the subsidiary will be zero, because here you have it the credit and here you have it debit. So now the net income 334 will go to the retained earnings. So here we have beginning balance, net income, dividends, and ending balance. Remember one thing, we don't take the retained earnings of the subsidiary. If you remember from example 1, I closed off the common stock and the retained earnings. So now I need to close off this retained earnings. So I put it debit, because we don't take the retained earnings of the subsidiary. The net income also, we need to close it off. The dividends, we need to close it off. And then we take the parent company. So you can see here 706, 334, 237, 803. This can tell you that we don't take the retained earnings to the consolidated balance sheet. In the previous example, it was one number, retained earnings. In this example, one statement. The principle is the same, that we don't take retained earnings. Now let us jump to the balance sheet. We need to close off the investment as we did in the previous example. So here we close off the investment account, we close off the depreciation, 18,000, and then we add up the total. So here we add the cash, receivables, inventory, but the investment will be zero. Then we add land, and then building, and then accumulated depreciation, and then we get the total assets, 1,581,000. Then we jump to the liabilities. We add the accounts payable, bonds payable, common stock, and retained earnings will be offsetted. So we end by the parent company common stock and the parent company retained earnings. So please remember, it's the same concept, and then we get the total assets, 1,581,000. In the assignment, you will see similar examples. To do it well in the assignment, please try to do those examples a couple times along with the exercises I made in the previous video. Also, you can watch the presentation that has been made by the publisher under the slide deck. I put it on bright space. It should be helpful for you to get a high score in the assignment. Feel free to reach out, and remember, we have the third chapter, and after that we will have the first exam. So I strongly encourage you, as you do the assignment and the quiz of this week, to take notes, because you might need these notes for the exam. Thank you so much, and we'll get back to you soon. Bye-bye.